Hello, everyone. Welcome to the latest episode of Multifamily Investor Nation's webinar. I am Brian Bornhorst, the head of asset management for PassiveInvesting.com. Today, we're kind of stealing something from two of my favorite podcasters, the New Heights podcast, the Kelsey brothers, who are from my hometown of Cleveland, Ohio. Basically, there are no stupid questions here. So anything that you guys want to know about real estate, I'm happy to answer any questions you guys may have. Just as a little bit of background on myself, I have over 30 years of real estate experience covering almost every industry within, or every sector within the real estate industry, dealing with valuation, process improvement, software selection, even went as far as valuing a baseball stadium in my past life. So with all of that experience, I am happy to answer any questions people may have. Just as some background, I used to be the head of transactions for a large apartment REIT headquartered here in Denver. I've done about $9 billion worth of transactions and managed portfolios as large as 160,000 units. So there's really not much in the way of real estate that I have not touched on. Just as a reminder, we'll pull up a photo of our managing partner's new book that they have out. You can find this on Amazon. This is a great opportunity for people to get an in-depth understanding of what apartment syndication is and what you can do. And if you do purchase it, we would ask that you provide a review for the book. Would love to hear what you guys have to think about it. With that being said, I will open it up to any questions that you guys may have with regard to real estate, asset management, analysis, you name it. I'm here to answer your questions. Not seeing anybody putting out questions just yet, so I'll give you kind of a quick overview of kind of asset management and some of the functions that it has. Basically, my definition of asset management is taking the investment plans that your investment strategy has and boiling those plans down into a manageable, actionable items that you can use for managing the property. This way, you're bringing that 30,000 foot level down to the grassroots level, and then converting all that information from the grass level back up to the 30,000 foot level. So that's kind of what I focus on. So when I look at these, here we go. Some of the questions: what KPIs do I monitor on a weekly and monthly basis? Yeah, since I oversee a diverse portfolio of multifamily assets, self-storage, hotels, and car washes, the KPIs vary from asset class to asset class, but we'll focus on multifamily. One of the things that I look at every week is our physical occupancy, plus the leasing activity that happens each week. So I know what the traffic is at the property and how we're converting potential renters into actual signed leases. I look at the availability of the units, how many units are rent ready, how many are not, how many are pre-leased, so I can see what our activity is. I do track our asking rents and our in-place rents on a weekly basis. It's difficult to get an idea of what's happening with the rents week over week. But when you start to trend that over 6 months, 3 months, 12 months, you can see directionally what's happening with the property. There are variances that happen week to week, because if, let's say, you have a whole bunch of 3-bedroom units move out, your average rent could drop quite a bit in a 1 week period. But directionally over time, as that balances out, you can see where your rent growth is happening, or if there's anything that's impacting your property. The other key point to note is that there's sometimes a relationship between your occupancy and your rent that you want to stay on top of. So if your rent is going up and you see a slight dip in occupancy, it could be timing of the leases. It could be that you're actually getting more rents, but people are moving out quicker. So those are the kind of key data points that I look at on a weekly basis. On a monthly basis, I'm looking at our collections percentage, but it's a little bit different than delinquency, because one of the things that I like to look at is where we are in collecting rents on a weekly basis. So how much rent have we collected for this current month by the 5th of the month, by the 12th, the 10th, the 15th, so I can see whether the quality of our resident base is improving or getting worse. That is something that we kind of started a little bit over COVID, because we were trying to see if there was a negative impact of all of the delays and evictions and things like that. But the reality is it gives us an indication of the strength and quality of our resident base. You're always going to have people that don't pay, but if you consistently are able to hit, say, 90% collection percentages by the 6th of the month, and then you're at 95 by the 12th, that number should be consistent month over month over month. So I always like to look at those data points. On a monthly basis, I am looking at our expense ratios and seeing where there are hiccups that may not be just seasonal items within your operating expenses. By looking at that, you can answer the questions, or if you have a good management company like we do, they will provide a variance report that explains specifically what some of the larger variances are. Now, in some instances, it could be a percentage variance where your costs go up by 50%, or it could just be a large dollar amount that you have a trigger that says anything over X dollars in a given category is something I need to have explained. By looking at those expenses, you can stay on top of it. And then also you can look for possible erroneous bookings of things where some expenses that should be replacement reserves are actually put in repair and maintenance, et cetera. So you want to make sure that you are balancing out how those numbers look month over month, quarter over quarter. So let's see, we have another question here. What resources, books do you recommend to get better at asset management? You know what? That's funny, because asset management really doesn't have a lot of glitz and glamour about it. There are a bunch of books on, how to do real estate management, how to do real estate underwriting, our managing partners books on syndication. But asset management is something more that you have to kind of get a feel for it. Because I have 30 years experience, I've learned from working across multiple sectors within the real estate industry, whether it's hospitality or industrial, retail, multifamily. There are a lot of things that you can learn by looking at those different data points. Some of the data that we can get that's paid, like Yardi and RealPage, all have great reports that that provide a good overview for the industry as a whole. The one thing I like to point out is when you're looking at this data, it's important for you to understand that operating expenses tend to be a macro benchmark, so that you can look at an MSA and say our operating expenses should be relatively consistent within an MSA. But the revenue side is much more micro. I mean, it's down to what street corner you are on, and whether your property has good ingress egress versus another property. It could mean a 5 or 10% difference in your rents, just because the property is easier to get in and out of, and people that want to live there like the convenience of being able to turn right on red and all that stuff for your site. So understanding the nuances of those income and expenses are important. Let's see what else we have here. Do we self-manage? If not, why? Well, we don't self-manage right now. We're in a smaller portfolio. We have about 3,600 units. The way I always looked at it, and again, this came from part of my consulting background, is there's three ways to manage a business. You can build it, you can buy it, or you can rent it. So when you look at building it, you have to understand all of the infrastructure costs associated with putting a management company together. That's payroll, that's accounting systems, that's lease management systems, that's all of that back office stuff that we are looking to provide the best solution to our finance team and our acquisitions team. That's a lot of investment. So you want to make sure that you can justify that back office expense compared to, say, your management fee. You can rent it like we do, is where we are outsourcing our services to our management company, and they have invested in all of that back office infrastructure. The beauty about that is they have a much larger management portfolio than we have, so they can spread those costs across a larger portfolio. The third option is to kind of buy it, where you go out and buy a management company and you make your big investment, but then you're spreading that cost out over a larger portfolio. So that's the type of analysis that we do, and we do it for almost everything. So when we look at an accounting system, you can build it, you can buy it, you can rent it. A lot of times you don't want to spend the money in investing in an accounting system when stuff off the shelf handles all of the needs that you have, or most of the needs you have. The biggest question that you need to answer is, what do we need? And that needs assessment is how you should approach all of your vendor selections. So when you're looking at whether it's a landscaper or a management company or a pest control, you want to understand what you need and have a clearly defined scope, and then you can put together that RFP for services and have a good apples to apples comparison. Let me see. One of the questions, you didn't mention DSCR and NOI is something you monitor monthly. Those numbers are actually a little bit more micro for our I'm sorry, a little more macro for our review on a daily, weekly, monthly basis. We run those tests every month because we have to for our lenders. So the DSCR is something that we review, but the issue is it depends on what type of debt you have. If you have fixed term debt, then the DSCR is a little bit easier to manage. If you have a variable rate debt, then you have to review that as part of our kind of overall finance planning for the portfolio. Luckily, with PassiveInvesting.com, we have a commercial finance group that handles all of our loan information. So a lot of that is not on my shoulders. So it's not a critical point for me to look at. But when I start to look at the expense numbers, that all rolls into the NOI. So that's kind of the trigger, is I want to get into the nitty gritty of the details of what's driving the impact to the NOI, not just looking at the NOI as a whole. Because what ends up happening is you could just say, hey, the NOI looks great, but you may see individual line items in your expense reports that could, over time, lead to a decrease in your NOI in the future. So you want to manage those expense items. All right, let's see what else we have here. What one or two items would you consider the most telling regarding the termination or determining? Sorry, I have to adjust my glasses. Determining ongoing deal, debt ratio, DCS, occupancy, collections. I don't think any one thing is important, is more important than another. In this market, it's very, very similar to 1993. It's very similar to 2002, very similar to 2008, when interest rates were higher. The one unique part about this market today is that we've had such a long stretch of low interest rates that a lot of the people that had experienced those cycles of high interest rates, a lot of people investing now have never seen interest rates above 7%. Deals can get done. The good thing is the core demand for multifamily is still strong. Our population is growing in the strong markets. As long as you have a growing population and demand drivers for multifamily, you're going to be able to stay on top of these deals. Biggest issue right now that we're experiencing is sellers are not as realistic in their pricing. They still think cap rates are 4%, and when you have interest rates at 7%, you're not going to do a deal at a 4 cap. But that being said, you can. One of the concerns I have right now is inflation is driving a lot of our expenses up faster than we can grow rents, because things are slowing down a little bit in the economy, and we're not in a recession, but you can hear the whispers of it. If inflation keeps going the way it is, we may not be able to keep our rents up at the same rate as inflation, and that's going to be problematic for people, especially if you don't have rate caps and things like that as part of your debt structure. Let's see. How do you approach risk management in your portfolio? How do you communicate asset performance and strategies to stakeholders? Well, we communicate monthly to everybody. From a risk management standpoint, one of the things that we do is quarterly or at least semi-annually asset updates, where we review, and I physically go out and look at every one of our assets to ensure that we're maintaining them. So doing preventative maintenance is important so that you don't get into a situation where a small item can become a big item. One of the things that we note, and why we have things in our leases about like water leaks, is you may see a little water stain in a unit and not think much of it because, oh, it's no big deal. But if there was, let's say, a nail hole that went through a sprinkler line, over time, that can cause lots of damage to your property. So it's important that you do regular inspections of your property and physically go out and see the assets. Not that I don't trust our management company, but sometimes they don't have as critical of an eye as I do. So if you are maintaining your assets, it's important for you to get your own eyes on those assets to ensure that everything is performing as the management company says it is. Even if you self-manage a property, if you have employees, one of the things I experienced in my past life is if working for a large company and the regional managers are saying, hey, everything's great, everything's wonderful, keep giving us capital because we're going to keep pushing rents. And then they start to move funds around across different assets. And then all of a sudden they come back a year later and say, this property is horrible, you need to sell it. It's falling apart. It's not working. Without going out and physically seeing those assets yourself, you lose that ability to have that critical eye. Let's see what else we see. Why are seeing occupancy drop in multifamily fundamentals are so strong? We are in the Greenville, Atlanta, and Mesa. Okay, well, here's one of the issues with regard to occupancy drops. It depends on the type of assets that you're in. In a downward market, you can end up having strong occupancy, let's say in Class B property types, because B assets, you're going to get the benefit of people that can't afford the A assets that are going to move down into the B assets. And then in the C class assets, the people that can't afford the B assets will move into the C. With the influx of new renters coming in, you may start to see people get pushed out of the C type assets. So occupancy can drop just because people then start to look for ways of cutting costs. So what was once a great asset, like in certain markets like New York, efficiencies were all the rage because, hey, everybody wants to live on their own and get their own apartment. Well, when rents start going up and it becomes too expensive, they start to look for roommates. So you may see occupancy dip in an asset that has, say, a high percentage of 1-bedroom units versus 2-bedroom units because people can't move in together and share that expense. So you can see that occupancy start to slip. Again, in 2007 and 8, occupancy started slipping because they took a lot of units out of the marketplace to do condo conversions. And then you found a lot of people living at home. With COVID, you see a lot of that happening nowadays. Anecdotally, one of the things that we're seeing is the rise in VRBO and Airbnbs because people are still working remote. They can travel anywhere in the world and work. So we are seeing a little bit of that happening where the younger generation is finding cheaper places to live by renting an Airbnb for a month and working out of there, and they get the opportunity to travel. All right, let's see. What tips do you have for resident retention? What we focus on is listening to our residents, getting strong reviews. There are a number of programs that we have for our residents to provide feedback to us and our management company. But the other thing that we also do is for our properties is we do hold resident events on a regular basis. So we try to build that community, and by building that community, you also get referrals. In some markets, you can't offer referral fees to residents. In others, you can. But by providing something else other than just a place to live and a limited experience, because again, not everybody will use every amenity that your property has. But by holding events, one of the things we do is we look for vendors that will share costs with us or that will cover the cost directly, whether it's yoga classes or food trucks coming out to the property. All of those things that show our residents that we appreciate them and we're trying to give them a better experience is important. Do we secret shop? Yes, I do. I shop constantly. I know our management company does. I have a whole routine. My wife would hate me for saying it, but every time I go to a new market, I'm like, I'm recently divorced. I have to find an apartment. Moving in from out of town because I'm in Denver, so I'm shopping elsewhere. You have to have a very, very strong story, but it's great to go out and get the real information. Because the other one key about secret shopping is you also want to make sure that the comps that you're comparing to are actual comps to your property. So we've had assets that were going through major renovations, and our management company, our old management company, was still benchmarking against Class B properties, even though we moved the quality of our asset to an A-. Because we went out and physically did the secret shopping, we could see why they kept saying, "Oh, we're doing great. We're outperforming the market. We're $50 above where everybody else is." The problem is they should have been $125. They were benchmarking themselves against the wrong asset class because the property now had granite and it had stainless appliances and washer dryers. And the properties they were comparing against were 90s product that had laminate countertops and no washer dryers and black appliances. So going out and doing the shopping on your own or ensuring that your management company is doing a true apples to apples comparison is critically important. Let's see. How frequently do you visit your properties? Our management company, these are both questions from somebody on our, I'm going to do the second one first. Our management company is the one that is in charge of organizing the community events because they're on the ground. So typically our property managers and the regional managers have a say in that. How frequently do I visit the properties? Like I said, I try to do it quarterly. But depending on my schedule, because again, I oversee both multifamily, storage, hospitality, and car washes. I definitely get out to see every property at least twice a year. That way I can see how capital projects are going, how well they're doing their preventative maintenance, and just getting to know the people, the staff on site. Because again, as the owner rep, I don't want them to be scared of us. I want them to see us as a partner, to make sure that they understand they can ask for resources from us to help improve the property. They just have to justify it. So they say they need to paint the clubhouse. I want to go and see the clubhouse to see if it really needs to be painted, or if there's something else that we can do to make the property better and more appealing to our guests. How much are the usual asset management fees, and what factors make them vary? Well, there's a number of ways you can do asset management fees, and I won't get into how passiveinvesting.com structures it, but in the industry standard is you can have a asset management fee that's based on the gross revenue collected, so similar to a management fee, or you can set it up as a basis of the equity, so the actual assets that you invested in the property, you can base your asset management on that. That tends to be more of a fixed asset management fee, whereas one that's based upon the revenue generated is more of a variable. What marketing do you use? Apartments.com. We use everything. That again, I defer to the people on site as to what they are able to do, as long as they can justify it. So we do have pay-per-click ads, we have Google ads, we have apartments.com, we have Zillow. All of those are arrows in the quiver of marketing, but we also have used in the past Facebook Marketplace and other online venues, because again, the younger generation tends to do stuff more on social media, so we want to have a social media presence. The key that we found out in working with our management company is that social media presence has to have some value. So we want to make sure that people are seeing it and driving some experience while looking at that. So the benefit of holding all these resident events is we do get to post a lot of pictures and highlight the fact that we're doing things at the property that if you live with us, you could have that benefit. Let's see. What do you think asset management fees? What do you think of asset fees of equity? It depends on the structure of the deal. There's a lot of stuff that we bring to the table. So again, asset management fees are derived on a deal by deal basis, but the value in having asset management is you are not only preserving the quality of your asset, but you're also having detailed oversight that ensure your properties are achieving the objectives that you set forward. And if they're not, being able to explain what is driving the lack of performance from that to that extent. So when we look at just recently, our rent growth for the last 12 months has been very, very strong, even though things have slowed down. With them slowing down, we can't necessarily control all of inflation, but we can look at where we're spending our money and where we can cut back to ensure that we're being as efficient as possible. The hardest part right now is there are things that are out of our control. Taxes, insurance, and payroll. Those are things that we can't necessarily push. You can adjust your payroll and pay a lower fee, but one of the issues you're going to get to is the quality of the employees that you have. You can't really mess around with insurance too much because, again, it's a commodity that is fairly well versed in the market and everything's going up. It will get back to normal. I know after every hurricane that hit, insurance costs spiked, and then insurance providers pulled out of various markets. I know that just happened over the last 12 months in Florida, but in another 12 months, everybody's going to realize, wow, we made a lot of money insuring homes in Florida, we need to get back in, and they'll come back in. So it's just something that you have to be on top of and make sure that you are rebidding things on a regular basis to ensure you're getting the best value you can. Let's see, we have a few more minutes here. How do you handle unexpected issues that may arise properties under your management? This happens a lot. For some reason, we've had a lot of lightning strikes. That's something we can't control. We do a cost benefit analysis every time these pop up to see what the costs are to repair the damage from a lightning strike versus installing, lightning rods at every property. If it's a big property that has 10, 15 buildings, installing lightning rods could be very expensive. If it's a smaller one that may be 2 or 3 buildings, it may make sense. One of the keys that we try to do is I kind of harp on this, is the preventative maintenance aspect of it. You want to make sure that you're at the properties and seeing that your landscaping isn't overgrown, so that you're not getting mildew built up on the side of your property, that you cut back your landscaping, that the drainage around your property as well, that you go in on a regular basis and check for running water or leaky gaskets, or just little leaks that are happening because gaskets decline with age. So having a strong preventative maintenance program will allow you to catch things before they become big ticket items. So one of my biggest pet peeves is not spending money to clean out the gutters. It is one of the easiest costs to cut for people, but it's also one of the potential risks for increased damage to your property by not doing something as small as cleaning out the gutters. Same thing with termite bonds. A lot of lenders are now requiring that as part of their loan documents. So you have to review your loan documents in detail. But if you are not proactively looking at your property and saying, wow, I need to cut back on expenses, where do I want to cut? It's very dangerous to cut areas where the risk associated with not having it, like car insurance, you don't necessarily need it because you're a great driver and you only drive so often. But if you get in an accident, you have to come out of pocket to pay for that damage. That could be very, very expensive. It's the same way with termites. That incremental cost is there, and there is a significant risk, because if you end up getting termites, the cost to repair is significant. So being able to oversee and manage the maintenance of your asset is critical, because again, our management company is driven to get to our NOI targets. But I want to make sure that we're not cutting in areas that would potentially cause problems in the future. So, let's see, any other questions for people out there? Like I said, this is our opportunity to there are no stupid questions. So please ask away. See, how is the rental market in Greenville, South Carolina, in terms of both rent prices and duration? Tenants typically stay in units. Greenville is still a growing market. We see it as a excuse me, as a strong growth market. There's a lot of things that are happening in that marketplace to help drive multifamily success. One of the concerns is that there is new development that has hit that market, and because it is a secondary market that may not have as strong of a absorption as you would see in other markets, because the population growth just isn't there. With regard to the tenant duration, our goal is to try to get north of 18 months with regard to our tenants. We know what the cost of turnover is, and in strong markets, like Orlando and Charleston and Charlotte and Houston to some extent, you can still achieve rent growth and maintain your tenant base. A lot of times, if you are doing a value add project, you may have to actually re-tenant the building. So when you do your underwriting, you may want to look at the resident base, what the quality of the tenant base is, income, employment centers, where they're located, and compare that to what you're trying to achieve once the renovation is done. Because there's a number of ways you can do your renovations. You can either do it, on the turn, which takes 18 months because you have to move people in and out, and it does have a long drag on your occupancy. Or you can do it like a lot of the merchant builders do when they do major renovations, is they come in, they vacate an entire building, move people around, renovate the entire building, and then move on to the next one. There's pluses and minuses to both of those, but you also have to remember, if you are moving a product from a B to an A, the quality of the tenants that are in that property today may not be the ones that are going to be there when you move it to the A. And then you also have to look at the impact that you would have on that property in the interim. So when you have a mix of tenants and tenant bases, that could cause some conflict. Let's see. What tools, softwares do you utilize to enhance asset performance? Well, there are a number of softwares available. I tend to actually just use Excel. It's a small enough portfolio that I can do enough analysis within our portfolio that allows me to measure against good data. One of the strongest things that I could recommend is getting benchmarking data from either brokers or data sources like Yardi or RealPage, where you can get those MSA level expenses, and you can start to look at how your property matches up to the market. Like I said before, operating expenses are at a macro level. So an average for an MSA could be applicable to your benchmarking. So you want to see how much your utilities are as a percentage of your revenue, or how much your utilities are on a cost per unit basis. Those benchmarks are important to see if you have opportunities to, in fact, one of the other questions is utility control. That's where you start to see where you may have an opportunity. So there's properties that may have, direct bill, sub-metered, everything else, so that those bills are passed directly on to the residents, so it's not that critical to you. Others are using RUBs that are trying to get back reimbursements from the residents, but those tend to be in arrears. So you end up having that offset, especially when people move out, that you may have a gap with regard to how you're recovering those utilities. So by benchmarking your expenses, we like to focus on, at a macro level, the overall expense ratio, trying to stay under 40%, 45%. Because again, our portfolio is a little bit new of a portfolio, so we have a little more efficiency built into all of our systems. When you have an older Class B, 90s, 80s product type, your expense ratios are going to be slightly higher because you're going to have more repair and maintenance, all of those items. So again, knowing what asset type you have and then seeing how your ratios stack up against the macro market, those are good things to track. Let's see, what else do we have here? What do we provide to our investors? Well, I provide whatever our investor relations group asks for, but typically we're sending them out rent rolls and trailing 12-month operating expense statements on a monthly basis. On a quarterly basis, we may provide more detail, and it also depends on the level of investors. the GP levels versus the LP, that they may get a difference in the detail that they get. But we do provide monthly reports to all of our investors, and then we provide quarterly reports as well. What questions do we ask when I secret shop our own properties? It's harder for me to secret shop our own properties because I go to them so often. So I tend to rely on our management company to secret shop with other people from their company, or I do secret shopping over the phone where I can call and they don't necessarily have my information. But questions that I ask are typically what our rents are, what the concessions are, the property. Is there any opportunity to save money? Do they have any specials going on? I always ask about crime. They can't really say much because they don't get that data. But I also ask about what the biggest complaints that the guests have, because I want to know what our residents are experiencing and what issues they may be having. I also look at all of our reviews on a regular basis. So probably every quarter I go through all of our online reviews and see if there's a trend that's happened at the property. One thing that's important to ask all of your property managers and your maintenance staff is, what is the number one service call that we get? Typically in the summer, it's going to be the AC is not working. So we want to go in and I want to know what issues may be popping up that are a concern that we may want to look at doing capital planning for, with regard to like doing a full-blown HVAC service to clean out everything. You want to make sure that you are getting the information that you need to make your decisions. How do you choose your property management companies? Well, that is an important question. That's vendor selection. So the first thing you need to do when you're selecting a vendor, whether it's your management company or anybody else, is doing your needs assessment and finding out what you need from your management company. So you want to make sure that you know, these are the types of reports that I want to get from them. This is the type of maintenance information I want to have. This is the type of communication that I would like to have with them. We on some properties, we have weekly communications. On most, it's bi-monthly, where I just kind of get updates on everything from every property. But some management companies don't necessarily like having that kind of hands-on approach from ownership. I think it's important because I'm not necessarily just asking them what's wrong and telling them to make improvements. I'm also asking what they need. Do they need to provide more training? So when I look at the information that I get weekly, one of the reasons why I ask about that traffic versus closing rate is I can ask the question, hey, do we need to train the leasing agent more? It's not necessarily spending more money on marketing. It's, hey, can we train this leasing agent to become a better closer, to do their job more efficiently? And then saying, hey, can we get them that training? So again, selecting the management company that has those tools available to them was important for us, and making sure that even if we aren't getting the best staff at every property, if the management company has a strong training program, you can train somebody to be better at their job. And that's one of the things that we want to make sure that we're understanding is, it's not always marketing. It's not always spending money. It could just be, we need to give them better tools to help them close. And that's one of the things that I think is critically important for how you partner with any vendor that you're working with. Let's see, in your opinion, which cities in North Carolina, South Carolina are the places to be? Truthfully, the market questions are actually personal to each investor's strength. Right now, North Carolina, South Carolina are still both growing markets. Charlotte, Raleigh, Charleston are all growing markets where the population is increasing. Columbia, Greenville, again, all of the state of North Carolina, South Carolina are growing. They are growing slower than they were over the last couple of months or couple of years, but they're still strong. But the diversity of the assets in a market right now, Charlotte and Charleston have a ton of new development going in, whereas Spartanburg and Greenville or outside of Greenville, you can find some good quality assets that are maybe a class C that hasn't been renovated in a while, or class B that can use some upgrades to tweak it to a good investment. Every property type can make money if you buy it right. So that's the key, is making sure that you're making the right acquisition decisions. Expense ratios for C and Bs. Again, it varies by market, but typically we would see class B assets in the 45 to 50% range. Same thing with class C assets, assuming those class C assets have been well maintained. If they aren't well maintained and they have, poor infrastructure, you're going to see those expense ratios get above 50%. Okay, we've got about 2 minutes left. Just checking to see if anybody else has any questions, because I've been rambling for a while. I just want to make sure I'm answering your guys' questions, because I really do like this, because I would rather talk directly to you than come up with a big presentation. So perfect. Well, thank you all. You all have a great holiday week, and enjoy Turkey Day and be safe.